Hello and welcome to the Genuine Learning Blog. My name is Melissa Glasso, and I'm super excited to be here with you today to talk about tax advisory work and independence. However, this is not our first time covering this on the blog. Previously, PEEC exposed this back in June of 2024. However, like all good standard setters, they listened to feedback and they decided to re-expose this, addressing some of the concerns that were raised from the previous version. So this is going to be, again, it's a revised interpretation of the tax services ET, which is 1.295.160. So again, we're talking about independence and the role that tax advisory services specifically are going to have on independence. Now, when we look at what is driving this, in the 2024 proposal for tax services, there was a little bit of feedback around what a threshold that was included. We call the more likely than not threshold. So in the original proposal, PEEC indicated that if a member provided tax advisory or tax planning services related to marketing, planning, or opining in favor of a particular tax treatment or a tax transaction, and a significant purpose of the transaction, which initially was recommended directly or indirectly by the CPA, was tax avoidance, right? So in that scenario, if that is the case and the member could not conclude that it was more likely than not to be allowable under the applicable tax law or regulation, then threats to independence would be at an unacceptable level, and there would be no safeguards, and therefore an independence impairment. And more likely than not is the highest threshold that the IRS offers. So let's take a look. So here are the thresholds that are used by the IRS when we're looking at the levels of confidence that the tax position will be upheld. And so the more likely than not is the highest is at least greater than 50%. In that scenario, you would not be required to provide a disclosure. Below that would be substantial authority, which is about 40%, or realistic probability of success, 33%, and then a reasonable basis, which is at least 20%. But note, you would have to disclose that particular treatment. And people came back and said that this was, a very difficult, very high threshold. And there are differences between GAAP, audit standards, and the IRS rules. So ultimately, PEEC came back and said, you know what, a singular threshold is not appropriate and that we should use facts and circumstances. So going forward, members would be able to use their professional judgment to determine whether the tax services performed result in any significant threats to independence. So instead of having sort of this threshold that if it's above it, you would have to say that threats to independence were impaired, it's going to allow you to consider facts and circumstances, right? What is your level of confidence? That is a factor, whether it's based on established practice or whether the tax services are designed solely for tax avoidance. And so take some of the information from the previous standard or the previous proposal and incorporates that in order to make it a more principles-based approach here. So as you think about this, the facts and circumstances for tax planning and tax services are going to vary a lot, right? So what are you being, what are you suggesting? And so as a result, professional judgment would be used in lieu of having this very specific threshold. In addition, some commenters expressed concerns about how certain what we consider to be routine services related to tax preparation, right, the return preparation, could potentially be seen as marketing or promoting a particular tax treatment. And so they added an additional paragraph that said tax return preparation services include assisting the client with their tax reporting obligation by drafting and compiling information, right? That makes sense. However, it also goes on to say advising on the tax return treatment of past transactions and responding on behalf of the client to the tax authority's request for additional information and analysis. So this would be part of the tax prep as opposed to the tax advisory services, which has slightly different rules. So this is a clarification that was requested. PEEC is currently proposing an effective date 1 year after this is published in the Journal of Accountancy. That's how ethics standards work. Once they put them in the Journal of Accountancy, they can then consider you informed. That's how they publish them. And then the implementation date is based on that. So comments are due December 15th of 2025. So if you are interested in this area, I know having taught a lot of tax advisory services over the last year, we've gotten a lot of feedback in our classrooms. And so I'm hopeful that this is addressing it. And if it's not, perhaps you can give more feedback to the AICPA's Professional Ethics Executive Committee on where your concerns are for this proposal. So again, comments are due December 15th, and it's a simple email, ethics-exposuredraft@aicpa.org. All right, well, that's a wrap on this week's blog. Thank you guys so much for joining me, and I hope to see you on a future blog. Have a great day, guys. Bye-bye.